let's talk about the positioning of private equity, because many people get mixed up with venture capital, leveraged buyouts, hedge funds. So before we dive deeper into the private equity practice, we actually have to define what these words actually mean. What is private equity? Let's take a look. Private equity is an alternative asset class. As part of this class, investors usually invest in private equity among other alternative assets like hedge funds, and mostly because they want diversification. In fact, except for the top private equity firms, most firms don't actually return spectacular profits, but one of their advantages for investors is precisely diversification. And the same goes for the venture capital industry, which is actually a subset of private equity as well as hedge funds. They are all alternative assets. So before we continue, it's important to clear up what are the differences in positioning between private equity and other similar activities. First, between private equity and venture capital. Then, between private equity and investment banking. Then, between private equity and hedge funds. And finally, within private equity, the different types and scopes of investments. Because even if we do know that we're talking within private equity, there is still a lot of different investments and a lot of different funds. So first, to clarify the differences between private equity and venture capital, it's important to clarify the definition of private equity itself. Private equity, by definition, is an investment from any non-public source of capital in exchange for equity. This means that venture capital, mezzanine investments, bridge loans, and even angel investing are all considered private equity by definition. They're investments of private capital in return for equity. Very simple. But the question here is that when most people mention private equity nowadays, they are not talking about the whole industry, any of these investments. They are specifically referring to a stage of private equity investment, which is leveraged buyouts. These are the most popular type of investment, and they are for very late stage companies, usually with a global presence and with a market cap starting at billions of dollars. And these have very different scope and goals than venture capital. So I guess that, to sum it up, private equity, by definition, does include venture capital. But when most people are talking about private equity, they're not talking about all of the different investments. They're talking about leveraged buyouts in specific, which are a subtype of private equity, just like venture capital is another subtype. So when you hear someone talk about private equity and venture capital, technically it's wrong. But what they mean is leveraged buyouts and venture capital. So the quick answer is that when using the right definition, private equity actually encompasses VC, right? But when people say private equity versus VC, they mean leveraged buyouts versus VC. The differences between these in specific are many. Leveraged buyouts, as we mentioned, are investments in global established companies that usually just want to optimize operations ruthlessly, while venture capital is for much smaller companies that are just now starting to expand with a recently proved product. So if you need funding to expand your small company internationally for the first time, that's usually VC. On the other hand, if you have a titanic company like Nestlé or Dell or another one that is already a global player but wants to ruthlessly optimize, that will be a leveraged buyout. And naturally, leveraged buyouts are much later stage than VC, not just in terms of company size, but the value of the investment itself. So VC is usually anything from 1 million to 1 billion. It's usually actually in the range of tens or hundreds of millions, and it only goes further if the company really is worth it and really wants to grow using a VC model. So for example, Uber is one of the companies that has crossed the $1 billion mark with VC, but this doesn't usually happen. But leveraged buyouts, on the other hand, usually start at the $1 billion mark. If it's less than that, then probably the company is not established enough to merit a leveraged buyout. There's also a difference in how the investment actually works. So VC is what's called a spray and pray model. You want to find the next unicorn, the next startup that can grow in an exponential manner. In return, more than 100 times the original investment. These companies are very rare, so the only way to find them is to pretty much invest in lots of different companies. And it's completely reasonable that out of every 100 investments, 99 of them are going to fail. And the one that succeeds actually makes up for all of the other ones. It's still profitable this way. And it's actually how it works. Leveraged buyouts, on the other hand, have a very rigorous due diligence model for every single investment that they make. They need excruciating diligence. They have to make money on every single deal. And on top of that, leveraged buyouts are very precise. They have to create value and returns in a super specific timeline with a super specific blueprint. So in short, leveraged buyouts concentrate a lot more money in a lot less companies, and because of that, every single one of them should succeed. But they have one actual similarity among them, which is that they have a similar fund structure and a similar fund pipeline. Let me explain. While the actual maturity stage and the diligence done between both is completely different, the actual parts of the fund pipeline are the same. So there are usually three main stages: sourcing opportunities, investing in them, and then monitoring the investment after it's made. While the actual sources of deals and the actual companies are very different, these three stages exist in both. Whether VC or LBO, you have to source opportunities, you have to vet them with due diligence, and you have to monitor the investment after you make it. Another thing that's also very similar that we're going to touch on later is what is called the J-curve of returns. Let me explain. For any private equity or VC fund that lasts around 10 years and invests in the first 5 years, half of that lifetime, it's fully expected for it to have negative returns in the first years because you're putting in capital and getting nothing back. Then they break even at the halfway point as the returns start to come in, and then there's a third harvesting phase where companies are just producing more and more returns, and you just let the investments mature. So both of them have this model, right? The profits dip a little bit in the first years, then they reach a break-even point, and then they just shoot upwards. And this is common for both types. Another big misconception is between private equity and investment banking. They are not similar activities at all. In fact, they are complementary because they do different things. Private equity partners and investment bankers usually sit at different sides of the table. So investment bankers usually pitch deals for equity in companies to the private equity firms, to two types of buyers. And private equity firms are usually one of those two types. The other type is corporate buyers. So if you have a company that wants to do a leveraged buyout, somebody is going to need to buy them out. So the investment banker is hired to present that opportunity to possible buyers, and the private equity firm is the type of buyer. So the investment banker presents opportunities for purchasing equity in a company, and these are usually purchased by either corporate buyers or private equity firms, in some cases, both. So at that first sourcing stage of the fund, the private equity firm is always looking out for useful investment opportunities. As the name says, they're sourcing them, and these can come from multiple sources. Investment bankers are one of those sources. They knock on the door of the private equity firm and they say, hey, here are the deals that we currently have. Do you want to buy any of these companies? So the mindset that the private equity firms and the investment banks have is completely different. Investment banks just want to sell. It's how they make their transactions. They extensively prepare slide decks of hundreds of opportunities, keep identifying them, and keep pushing them to possible buyers. But private equity firms, on the other hand, have a completely different mindset, what's called a buyer mindset. They are very skeptical, and they need to go much deeper in terms of diligence. Because here's the thing, if the investment banker pitches the wrong opportunity to the private equity firm and they accept it, the investment banker doesn't suffer. They charge their commission. But the private equity firm is going to need to hold that investment, that disaster, on their balance sheet. So the private equity firm is very skeptical and only adopts the best investments possible. The investment bankers, on the other hand, can also be sellers of the private equity firm that's exiting the investment. So here's the deal. An investment banker brings you a deal so that you buy it as a private equity firm. You buy the company, you invest in it, you increase its value, and then you want to exit the investment, sell it. So for that purpose, the investment banker can now help you as a seller instead of a buyer. So they'll take your opportunity and now go sell it to corporate buyers or possibly other private equity firms. Another possible misconception is between private equity and hedge funds. These are usually very different. Although they are two classes of alternative assets, they usually have very different scopes and operations. The only commonality is that hedge funds sometimes perform very specific private equity investments, but these are usually very rare and opportunistic because if the hedge fund wants to do mostly private equity investments, then they're not going to be a hedge fund, they're going to be a private equity fund. The major differences are that hedge funds are usually open-end funds, while private equity funds are usually closed-end. Or in other words, when someone invests $100 million in private equity, they are investing blindly in a fund that will stay there for 5 to 10 years. They don't know what assets the company will hold, and the capital is drawn down over time. It's not immediately charged. You are going to have what are called capital calls, because every time that a private equity fund finds investments, they take a little bit of their investment money to close that investment, and they keep doing that. On the other hand, in an open-end fund like a hedge fund, an allocation is immediate. So if you invest 100 million, you will be expected to commit it immediately. And if the hedge fund has the firepower, it will be applied to trades immediately. You usually won't be locked into having the money there. I mean, this depends on the provisions of the agreement, but usually there is more flexibility and redemptions can be made. So in other words, in a private equity fund, the money is usually locked, period. But in a hedge fund, the money can be taken out. And usually you have people coming in and out. That's the difference between closed-end and open-end. One thing that we'll talk about later is that in private equity, there is something called the secondaries market. It works in the following manner. As we mentioned, in a private equity fund, the investor is locked into the fund. They invest blindly, and they have to wait until the end of the fund lifetime to see the returns. But what happens is, if an investor wants to leave in the meantime, they can sell their interests in the fund to another investor that is going to come in and replace them under the exact same conditions. It's not the perfect solution, but it allows for more liquidity for investors. But as we're going to see, these are also complex transactions that are not easy at all, either for the investors or for the fund. And finally, even within private equity firms themselves, there are multiple approaches and focuses. Leveraged buyouts are the most frequent and the most famous, or infamous, type of transaction. But there are many others which, as we saw, include venture capital. Some examples. There are private equity firms that invest in any sector, while others invest in specific ones. It's not uncommon for major firms like Blackstone or KKR to raise multiple funds and have some of these funds be only for media, only for tech, and so on. Some private equity firms want to create value quickly and flip the company, which is the case for an IPO or sell it to another private equity firm, which is usually the case with leveraged buyouts, where you have a master plan, a 5-year horizon, and after that, you're done, while other private equity firms want to keep their investments in the long term. For example, with real estate. It appreciates in value over decades. Some funds focus specifically on financial engineering, which is changing the structure of a deal to optimize it and improve the financial instruments, while others focus on operational optimization, which consists of reducing the company's operational expenses, or OPEX, your recurrent spending. The trend over time has been towards the latter because there has been a lot of shady financial engineering, especially with junk bonds. So the rule nowadays is for private equity funds to focus on operational optimization. You will see this much more frequently. And finally, while some private equity companies take complete control of the company, which is the case for leveraged buyouts, which, as the name indicates, they literally buy out the company, either the private equity firm itself or together with the company's management team. On the other hand, other private equity firms are happy just spectating, injecting a little bit of capital, and watching the company grow, which is the case for growth equity, for example. So as we see, private equity comprises many different types of investments. And usually, when we talk about private equity, we're talking about leveraged buyouts. It's also important to understand that within private equity itself, there are usually different types of funds with different types of investments.